Let's go back to Tesla because you are seeing a big surge in the stock. And in fact, for the year, it's up more than 25% off the lows. I think it's up something like
40% off the actual intraday low.
Exactly. And our next guest says the stock is still undervalued. Let's bring in Seth Goldstein, equity strategist at Morningstar. Seth, let's just start kind of high level with the numbers. Obviously, the market responding well to the beat, but an optimistic forecast. What did you make of that?
Yeah, it was really clear that Tesla was focused on two things. First, they actually guided to delivery numbers, which is new for them, but I think it does help to calm market fears that the growth story is broken. So they guided to 1.8 million deliveries. At a minimum, they said they could have enough demand for 2 if the demand were to get there. And then they also guided to gross margins of at least 20%, which I think helps investors sort of understand how the price cuts will affect profitability, even as they continue to grow volume. So, while the profitability is going to be impacted from the price cuts and rising lithium prices for their batteries, they're still going to grow volumes. And ultimately, I think that's what the market is most focused on for the high growth name.
When you look at what Tesla reported, and I'm going to just talk a little bit about margins, because margins came down, but they're still really high for an auto company. We're talking 28% plus, but they are coming down. They've implemented these price cuts. How does that margin picture work through earnings expectations? And I guess you could go right to valuation then.
Yeah. So in the near term, we are expecting further margin contraction, but the Tesla CFO also said on the call that about 5% of their unit cost productions can be improved due to the ramp up of the Berlin and Austin Gigafactory. So that should largely offset a lot of the price declines. And they've even started raising prices on the Model Y. That should help offset that. But ultimately, in the near term, we are still expecting margin contraction this year. But over the long term, we think Tesla will be able to expand margins as raw materials prices abate and as their new factories ramp up.
I just want to get your thought on valuation because you do in your note to clients call it undervalued, which I think is something that not a lot of people have ever described Tesla as.
And certainly if we would look 12 to 18 months ago, we thought Tesla was very overvalued. But, I think when you're looking at a high growth name like Tesla, and it was clear last year that they were not going to meet their 50% deliveries goal that they said at the beginning of the year. The market was then searching for what's the right number, and the market took a very pessimistic view without firm management guidance. So, now I think we've seen the stock rally as Tesla has guided to nearly 40% deliveries growth this year at a minimum, and the market is reassured that the growth story is not broken. But even at current prices with the rally, we still do view the stock as undervalued relative to our $220 fair value estimate.
And how much of that hinges on the promises that Musk himself has made? I think that there is a lot of credibility issues around Musk. And are you concerned that he's over-delivering, talking up his own book? I mean, doesn't he have a record of losing the most amount of money ever by a person? Maybe he's trying to, jack some of that up.
Well, I do think that given that we received more firm guidance than we ever have before, that tells me there's a confident management team, and it's not just Musk. Zach Kirkhorn was giving firm numbers of what we could expect at a minimum from Tesla in 2023. So, over the long term, I still think Tesla grows deliveries to over 5 million vehicles a year by 2030. Then you add in other ancillary, higher profitable businesses, including their full self-driving subscription software, which did do over $300 million in revenue in the fourth quarter. You also add in the expanding U.S. insurance business, and I think this sets up Tesla for long-term profit growth, even as deliveries eventually we see slower growth than last year and this year.
Let's talk a little bit about the bear case. So, and there were a lot of bears. They seem to have disappeared recently, and the technicians love the stock price and its action, but reduced EV subsidies, charging station issues. The balance sheet, interestingly, payables were up 50%. Inventory looks like it doubled on a year-over-year basis. So people are focused on the balance sheet. Free cash flow, yeah, they have free cash flow. 7.7 billion, I think, in the year. But that's a pretty chintzy yield on a company of this size.
Well, Tesla is still priced for high growth. And, you know, when we look at the bear case for the stock, we put a $90 fair value estimate in our downside scenario where essentially we're assuming that Tesla hits to around 2 million vehicles, and then that becomes a steady state run rate similar to a BMW. And in that scenario, we're also assuming no impact from full self-driving, no impact from other ancillary non-auto businesses, which includes the Dojo computer. We're assuming no robo-taxi valuation. So when we sort of take out all these other businesses and just value Tesla as a pure luxury automaker, we get to a $90 fair value estimate. So, you know, when the stock fell to, I think, an intraday low of 101 in early January, we thought that a lot of the bad news was priced in, and that's when shares looked very undervalued.
And what about Musk himself? He's been a bit of for the bears, he's been an asset. For the bulls, a liability.
Yeah, you know, I do think that a lot of the sell-off we saw since the Twitter acquisition closed was due to Musk selling shares and potential concerns that, one, Musk would be distracted from running Tesla due to running Twitter, and then two, Musk may have to sell more shares to permanently finance Twitter. And I think that put a lot of potential buyers on the sidelines, at least in December and early January, because they didn't want to go against Musk potentially unloading billions of dollars of stock on the market.
Before I let you go, there's a lot of, headline-grabbing stuff around Tesla. But one of the things on margin compression that maybe doesn't get as much focus is the cost of lithium and whether or not that is an additional pressure on margins and whether that's fully appreciated by the market.
I do think that lithium, while we've seen lithium spot prices stabilize and we're forecasting about 70,000 a ton versus the current spot price of 72, the contract prices lag this number, and especially Tesla's contract prices, because they sign multi-year deals and they still are sourcing a lot of their lithium at a much lower price than current spot prices. So that certainly does factor into a lot of the margin compression this year, in addition to the price cuts. And we do think that will likely keep margins lower in the coming years, as we forecast lithium prices will remain well above the marginal cost of production due to an undersupplied market from growing EV adoption.